From the morning reading. Indices pause on Friday with new highs for Q1 2017 on the Qs, XLK, NRG, VRTX, and Apple as leaders year to date. March is over and the 2017 Q1 is in the record books. Here's the bottom line year to date. Year-to-date leaders since December 30th, 2016, the Qs up 11.73%, the Spiders up 5.46%, Diamonds are up 4.47%, and the IWM Russell's up 1.95%. The VIX during that time dropped 1.67 points. Breadth weakened compared to the prior session as advancers led 1771 to 1216 on the New York Stock Exchange and led 1550 to 1297 on the NASDAQ. On the S&P 500 snapshot, Friday's S&P 500 daily loss of 0.23%, but gains for Q1 came in at 5.5%. This week saw 3 consecutive days of small daily gains with a week-over-week gain of 0.80%. The U.S. Treasury puts the closing yield at the 10-year note at 2.40%. And other reading, we're sitting right under resistance right now in the pound, the yen, the Aussie, and the loonie, and a little further away on the euro. This week we could get above those resistance levels and break us into strength and uptrends. Bonds and equities have both found support, but a rally in both could be the combo that leads to trouble in a few months. Remember, bonds strengthen 2 to 4 months before equities top out. Stocks are struggling to keep up with the NASDAQ. The composite index reached a fresh high, but there are still relatively few stocks trading above their medium and long-term averages, and about half the number of stocks are reaching the 52-week highest we should be seeing. The dumb money is not into this rally, at least that's the case if we buy into the theory that dumb money trades in the morning, which is an iffy theory. For the week, the S&P 500 futures lost more than 1% overnight, but gained more than 2% during the day. That should be a good sign, but the last 2 times it happened were the peaks of the last 2 bull markets. The Dow's slowest quarter since 1965. During the first quarter that just ended, the Dow Industrials moved plus or minus 0.32% on the average day, the least volatile in more than 50 years. After its smallest range quarters in history, it averaged a return in the next quarter of only 0.6%. The bull market remains intact, but the market doesn't seem to tolerate too much correction before it rebounds, such as what happened this last week. There are reasons to be optimistic, but we'll see more churning or downside before the next leg up starts, likely. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:50 a.m. Mountain Time, and I'm recording this in preparation for the market day of April the 3rd, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And there we go. And at the time of this cut, futures were basically all above scratch on the 4 U.S. broad-based indices. Crude oil's up about 1/3%. Euro's down about 1/4%. Long bonds up just above scratch, and gold down just below scratch. In overseas action, it looks like China isn't open. Hong Kong's up about 2/3%. Japan's up about 0.4%. Germany's up just over scratch, as is the United Kingdom. And macroeconomic reports for the United States for today of note, we have ISM manufacturing PMI, and FOMC member Dudley speaking, FOMC member Harker speaking. Looking forward to tomorrow. We have trade balance, factory orders, and FOMC member Tarullo speaking. In terms of current volatility conditions, short-term VIX still below a 10 at a 9.66, and skew is also still elevated, so no changes in those relative valuations. Skew at a 138, so very much in the warning area, which would warn of increasing volatility in the next 30 days. IV percentiles on the S&P and the others are all still quite low. S&P coming in at a 9, the Russell 15, the NASDAQ a 12, and the Dow at 23. No standard deviation size moves were put in on any of the U.S. broad-based indices on Friday on a close-to-close basis. In terms of the charts, let's go ahead and bounce over there. The S&P, we did have the breakout last week, of course, above the short-term downtrending channel. However, action on that on Friday was essentially nullified, the breakout action, though it did not come back inside the channel. Actions from Sunday night into Monday morning so far, relatively small range, not much to add to this. So we have the expectation here at this point that in the short term, we've had a breakout above a downtrending channel. It's not a very strong breakout in that it's been largely nullified since. We'll have to see where this goes. Overall, the pattern coming into this was bullish, and we would expect that since we're above the key moving average lines, above the cloud, and with that breakout, expectations are a bias to the bullish side and back to the all-time highs. That being said, the short-term pattern is, it's not the strongest breakout, and it's not convincing as of yet. So, whether we have a little bit more weakness or sideways action before we make a next leg up certainly could be a theory espoused by many technicians. Dow has been relatively sideways in the short term, though the more intermediate and long term still is holding up as bullish. And the NASDAQ, of course, it's been the strongest, and we've had all-time highs put in on the NASDAQ just in the last recent sessions. Really nothing more to be said about that. It's a pretty clear and obvious pattern to the upside, though we've had some small range days in the most recent trading. In terms of the Russell's been in kind of a sloppy sideways pattern that goes back to early December. You had a bit of a move to the up that broke out of the range and established new highs just to have some weakness come in and kind of probe the bottom of the range since this early December period. So right now I would say we're largely neutral, and indeed we're right here at the cloud, though it is a thin cloud, right at neutral with the Russell, with fence to the upside and fence to the downside, and action currently pretty much in the middle of all that recent price action. Not a lot of clear indication coming from the Russell as to whether there is really any kind of bias to either side. In other markets, crude oil, short-term pattern, of course, been bouncing up off the bottom. Pretty strong recent sessions, bringing us up off that bottom. Question remains, and certainly the bias would be an expectation that this would then roll over, and this is basically a setup for people going short to take this short once again and give us a lower high. We are below several of the key moving average lines, below the cloud, and certainly below an awful lot of the recent price action, which should be posing as overhead resistance at this point. In terms of gold, gold has been playing up against this short-term double top. And as such, until it breaks out above that, I would expect pretty significant resistance in that area. So probably slightly bullish with close resistance and yet at the same time, or above some of the key moving average lines and above the cloud. So gold is kind of trapped in between two areas. We could see gold move into a daily squeeze and then a big move coming out of that. Right now, best guess would be that it would move bullish out of that pattern. But gold has been a very complex technical pattern of late, and one could argue that that there was an opportunity for this to move down as well. So gold, not the simplest, most obvious short-term chart at this point. In terms of bonds is likely to continue to make lower lows and lower highs. Right now, it seems like we've had a lower high put in, and we would expect this 145 and 26 handle to be taken out on the next leg down. Now, when that happens, right now we're quite neutral, sitting in the middle of a relatively thin cloud, pretty much wrapped around moving average lines. We'll have to watch the dollar and the indices and so forth to see which way bonds will break. And that might take a little bit of time yet, but bottom line is that bonds aren't giving a strong indication at this point as to near breakout. In terms of that dollar, the dollar had, of course, broken down in the last couple of weeks, and then last week had something of a recovery, with most of the sessions last week being stronger. But that's going to run into quite a bit of overhead resistance in terms of key moving average lines, the cloud, and other overhead resistance. So we still, in the shorter term patterns, have had a series of lower highs and lower lows, and we would expect that the next leg down on the dollar would be coming sometime soon, unless something really gives this some energy and momentum to break above these recent patterns. Okay, that's probably enough on the charts. Let's go ahead and go to the daily report. Daily report has been a bit mixed of late. We do have a market phase 5, which is that break of diagonal and horizontal support on the S&P, and yet at the same time we've had some recent price action that has brought us back up above and then between key moving average lines. Some would argue that we have broken into a bullish phase, but I would argue that we're either weak phase 5 or a weak phase 4, not a strong signal on either side, and as such, not much of an indication from the intermediate term phase opinion at this point. In terms of the three market timing signals, a little bit more clarity here, but certainly there are some short-term weaknesses that have come in. From IBD, the first market timing signal that we follow, uptrend under pressure. This is in warning status. In the second one, the GMI index, a 4 out of 6, though the second index indicator is at an 8 out of 8, so that one's as strong as it can be. This one has been in a buy signal ever since 11:10 and remains bullish. Stock charts decision point scoreboard is our third market timing signal, and you notice the intermediate and the long term are all in agreement that the market is in a bullish phase, and yet at the same time we've got these mixed signals with quite a few, there's 4 out of 8 that are bearish and then another 2 that are neutral. So short term is showing some inclination towards sideways action, some choppiness, legs both bullish and bearish, not likely to make an awful lot of progress in this kind of setup. We like to see the stack, of course, and right now we're in that unusual circumstance where we have a stack on the intermediate and long term, but the short term is showing some weaknesses. Overall consensus between the three market timing signals is bullish, especially in those longer time frames. And of course, GMI index is locked into that intermediate term time frame, as is the IBD signal. So we've got some deterioration that we're still playing with, and that should be something of a warning, especially to us in those shorter time frames. In terms of position sizing models, both models are, The first model is a portfolio investor position sizing model. It's at 50% right now. The second model, based on volatility, is still at that 75 to 100%. Now, this is one of those things that we have to keep in mind. It's really unlikely that we're going to have any significant deterioration in the market when volatility is so low. So without a real breakout in volatility, and right now we've been running under the 12 level, we're not likely to have any significant breakdowns. In terms of the intermediate term market posture, we are in a weak bull. If this goes up over 50, this will strengthen to a strong bull. But we're also with a neutral sentiment line, and this is another indication of expectation for mostly sideways action with small fence up or down, neither one likely to go very far. The Dow still in a strong bear. But then on the flip side, the NASDAQ is in a strong bull, and the Russell's also following, much like the S&P, in a weak bull, and could go to strong bull if we get some stronger action in the next session or two. So when you put all this together, the intermediate term market posture is quite mixed, but a couple things that you can take from it is NASDAQ is clearly the strongest index at this point. And even within the S&P 500, the technology sector is the strongest sector. We had some improvement in the shorter term to intermediate term in the S&P and the Russell, though the big boys and the Dow continue to be somewhat to the weaker side. In terms of the hedge warning status, we're currently still level 1 caution light, though some aspects have modified in recent sessions. We were at 1+ the middle of last week. In terms of strategy opinions, VIX, I will say, is borderline acceptable to initiate new positions for novice traders. We keep playing back and forth between below 12 and above 12. So pretty low volatility, not paying much premium. And we also have this situation with this level 1. So we would also say cover calls and put selling probably best described as borderline acceptable, and initiation of new positions if you're a novice trader. More experienced traders may take these kind of sideways conditions and then take various advantages of that. But just be aware, elevation risk is elevated a bit right now, and further deterioration is always possible once you start to see that happen. And looking at the specific areas of warning into the volatility area, you see we have this low volatility, and as such, you're looking for those signs and symptoms of expanding volatility. We've had a relatively high distribution day count in the last month. NASDAQ's at 5, the S&P is at a 6. Skew continues to be elevated. Then in the trend-based area, we've got several things here. Let's see. We have the weak market phase 5/4 on the trend phase. In terms of market posture, this has actually gone back to weak bull. So need to correct that one right there. That's actually weak bull. And then in the New York Stock Exchange, new highs, new lows, relatively benign. So not a lot of strong signals coming from this side here. In terms of the intermarket risk aversion indicators, we currently have 3 as risk off, 2 as risk on. These 2 risk on both developed during last week, and one became apparent on Friday. So this may show some signs of improving and firming market conditions, though at this point, with 3 is off and 2 is on, it's relatively neutral as the kind of consensus opinion coming out of that group of indicators. Sentiment's also locked into neutral, and so not a lot that's going to happen from that indicator group either. In terms of the sector-specific performance, Friday was mostly about risk off. You've got real estate, utilities as your leaders, but then you also had consumer discretionary, which is risk on, materials, information tech, all basically oscillating around scratch, albeit with relatively weak breadth. Worst performers on Friday were the financials, telecom, and energy. and you see relatively weak breadth as you would expect at the bottom of that chart. In terms of intermediate term, long-term, and short-term market postures by sector, we continue to focus on technology, and then to lesser degrees, consumer discretionary, and then materials. That's the three strongest and most consistent sectors of late. On the downside, retail, financials, and parts of healthcare have been probably primary sources of weakness in the market. In terms of performance as percent change compared to, say, 3 months, you can see this last month has been quite a bit weaker across all the different sectors, and this would be the month of March at this point, and essentially. And really, the only standout performance in the month of March was information technology, followed by consumer discretionary. Okay, in terms of the relative rotation graph, just taking a look at some of those industry groups or other sectors that are performing well, we would call out home construction and DHI and some of the other components of home construction. It's certainly been in the news quite a bit lately. XBI, the biotech part of healthcare, has been strengthening, so be on the lookout for that. Also, utilities continues to be relatively strong. FDN gave up a little bit last week. FDN being, of course, the internet index, but it's been also relatively strong. And then the REITs have also been in relative strong performance in recent weeks. So a couple interest rate sensitive sectors or industry groups, and then certainly the home construction could be also considered interest rate sensitive, and yet amongst the better performers. Then thrown in with that, biotech and the internet group. Okay, that's probably enough for today. Let's go ahead and wrap this thing up. And you've seen these slides during the initial morning reading sequence, and then I'm going to move to these right here. If you see anything of interest, just hit the pause button, and you'll also find additional details from the hyperlinks. And we'll move over to the disclaimers. Disclaimers, as always, hit the pause button if you need more time to read the disclaimers. Also note down here at the bottom the hyperlink that takes you to the full set of disclosures. Manage that risk profile always, and you'll find more consistent trading. Good trading to you, and we'll look to be back probably in a couple days with our next market preview session unless something significant happens.